Okay, can everybody hear me?
Yes, you
Yes.
are. Yes, we can hear you, sir.
Okay. Yeah, so this morning, we're gonna look at this stochastic simulation basically, or maybe a simplified stochastic approach, and liability valuation in the insurance industry. Uh, you learn about reserving in the actuarial mathematics taught in the university. I still remember when I started to look at the subject of actual science a long time ago. Yeah, the book we had at that time was still expressing the actuarial mathematics stuff very much deterministically. So everything was expressed as deterministic term. But then the revolution we had in actual science at that time occurred initially in 1986 when this book produced by the Society of Actuaries in the US, written by several people. But the name of the authors, the first one, put, in the list, was Bowers. So because of that, everybody knew, the book, as Bowers, So that book, was published, in 1986. And the difference, between that book, and the previous books, was that in Bowers, everything, was expressed, stochastically, So it was the first book, expressing actuarial science stuffs, stochastically. And since that time, a lot of books, have been published in actual science, following, the approach, the expressions, used by Bowers. So in this morning, again, basically what I'm going to do here is to basically just share, one simplistic stochastic approach, we can use, to look at insurance liability valuation. In the insurance company, from time to time, actuaries, have to identify, what they call reserve, yeah. And they put, the reserve value in the balance sheet, of the company from time to time. And it's something basically measures, the value of the obligation, of the company, in terms of paying, the insurance benefits, expenses, all those things, in the future. So in this presentation, we're going to see how it's expressed, as a random variable, and derive, basically the value, we can put, in the balance sheet, which is actually a percentile, of the random variable, So let's look at the next slide. Yeah. Yeah, a mathematical model, which is used a lot, in the life insurance companies, especially to model, the individual policies, is this model called double decrement model. Yeah, of course, you can make it, multiple decrement. You can have more than two, but usually, for life insurance policies, double decrement model, is going to be enough because what's important there, is that we're able, to model, the death and the event of lapse. Yeah, lapse means policy being discontinued. So the two decrements are included, in that model. You have the timeline, moving to the future, and you have those two decrements, along the timeline, to the future. So the policy can either get to death or get to lapse, every time, along the timeline. So for the analysis, let's assume that the company sells long-term traditional products only. In Indonesia, we have not just traditional products, but we're selling also, in the market, products, like unit product or maybe universal life, products. Unit link products are especially popular and sold, by most of the multinational companies, while traditional products, are sold a lot, mostly, by the domestic companies. Yeah. So let's assume, that for the purpose, of this illustration, this morning, we assume that the company we're considering here, is selling, only traditional products, and we're talking about long-term traditional products, not like the short-term traditional products, like uh, like term insurance, for 1 year. We're talking about endowment products here. Yeah, maybe 20 pay or 30 30 year, endowment. So when death occurs, company, will have to pay death benefits to the beneficiary involved, in the policies. And upon death, of course, if the premium payment, is still on, the premium payment, is going to be discontinued then because the policy basically is terminated, and the death benefits, is paid, to the beneficiary. Uh, and when lapse occurs, uh, the company will have to pay, what we call cash value benefit, yeah, to the policyholder. There is no death, of course, so we're going to have to pay the cash value benefit, to the policyholder then. And again, the policy is basically terminated, not continued. So the premium payment, is also discontinued. So the time until either, death or lapse, is clearly, a random variable. Yeah. Time until death is a random variable. Time until lapse, is also a random variable. So time until either death or lapse, whichever occurs first, is a random variable. Next slide, please. So if we look at the insurance benefit payments, in the future, say we assume, that the timeline, the time axis, to the future, is discretized, to say uh, uh, a monthly, yeah. We make it discrete, to the future. You can make it, annually, or you can make it, monthly. But basically, if we make it, the timeline, a discrete, thing, with say n elements, in the future, then the sequence, of those insurance benefit payments, say monthly or annually, is basically a stochastic process, right? We don't know, whether death is going to happen first or whether lapse, is going to occur first. So there is randomness there. So the time, until either death or lapse, is random variable. So if you look at that stochastic process, you're talking about stochastic process. Yeah, we're looking at that random sequence basically. The same is true, with the premium payments. We're dealing, again, with with the stochastic process again, because the premium payment, will stop, when either, death occurs or lapse occurs, or maybe if the premium payment term, finished. Yeah. So that sequence of premium payments in the future is a stochastic process also. How about expenses, of the company, or maybe expenses, associated, with this policy, we're considering? Well, it can be modeled, as again, a stochastic process, yeah, with n elements and random variables. So basically, if you combine, the insurance benefit payments with the premium payments and also with the expenses, uh, you get the net outflow sequence. Yeah, insurance benefit payment is basically an outflow, premium payment is an inflow, expense is an outflow. So if you combine, the three, benefits plus expense, minus premium, you get a sequence of random variables. So you're dealing, with a stochastic process again. Uh, how about the interest rates? The company is investing, its asset from time to time. So in each one of those cells, of the timeline, to the future, uh, you have a return rate, of the asset. Yeah. So you can model again, the sequence, of interest rates, in the future, as a stochastic process. Yeah. So because of that, let's move to the next slide. Because of that, the asset value the company needs, to be able to fulfill its obligation of paying future monthly net outflows, of the policy in the future here, is a random variable. How much asset, do we need to have to be able to deal, with all those net outflows in the future? You basically want to present value, those outflows in the future using the interest rates. Yeah. And what interest rates, are we talking about here? Interest rates, occurring, on the assets, of the company. So every time you get premium, you pay expense, you pay uh, benefits, you have the remaining assets, you invest, this asset, from time to time. So the value of asset the company needs to have, at this time, to be able, to pay all those net outflows, in the future, can be quantified, as the present value of those net outflows in the future. But each one of those outflows, random variable, and each one of those discount rates, is also a random variable. So the present value of those two stochastic process, you present value those things, using the interest rate, sequence. The present value is a random variable. Yeah. So that's when you're dealing, with just one policy. And imagine, an insurance company, has a lot of policies there. So you can aggregate, all those assets. You can imagine, you can add them up, to get the aggregate, asset value the company needs to have, to be able to fulfill all its obligations of paying future net flows in the futures, of all the policies, the company has. That aggregate value is again a random variable. It's the sum, of all those V, above, the TV here. Now, this present value concept, is basically a random variable. Yeah, but from time to time, to construct the balance sheet of the company, what we need to give, to the accountant, is a value only. We cannot give, a random variable, to the accountant. We have to give them, a value, a value uh, where we are comfortable, that the value in terms of asset value, is going to be good enough, uh, for us, to be able, to deal, with those net outflows in the future. So technically, what we need to put, in the balance sheet, is actually a good, percentile, or maybe a confidence limit, of the random variable. Yeah. So let's move to the next slide. In a random variable, you can pick, you can pick, the 75th percentile, maybe, or maybe the 50th percentile, or maybe the 99.95th, percentile. If you prepare, an asset, amounting to uh, amounting to or maybe equal to the 75th percentile, of the previous, random variable, uh, then the probability, of this asset is going to be enough, in the future, to pay all those net outflows. It's going to be 75%. Yeah. But if the asset amount, you put, in the book, you prepare, in the balance sheet, is only equal to the 50th percentile, the median, of the previous random variable, then basically the probability coverage, the probability that that asset, is going to be enough, to deal, with those net outflows in the future, is going to be only 50%. So we have to give this value, to the accountant. Which one do we give? Well, it depends. In Indonesia, the regulation requires, companies, to put, the 75th percentile, in the balance sheet. And not just that, uh, we have to the company, will need to have, what they call RBC, risk-based capital provision, equal to basically the difference, between the 99.95th percentile and the 75th percentile. Uh, of course, it's not known a lot, in the industry, but basically that addition, of capital requirement by the regulator, actually uh, is trying to position, the company to be able, to have uh, high probability coverage, uh, for the liability payments, in the future. Okay, so let's move to the next slide. We're going to look at the example now. And again, what I put here, the example, is generally a simple example. The goal here, is to basically to describe, the liability, as a stochastic concept. Okay, so it's simple, uh, but the goal here, is to show, the randomness, the stochastic nature, of the concept. Yeah. So in this example, we're dealing, with an endowment product. I hope you understand already, endowment products, the traditional endowment products. Let's get to the next slide. So there's only one policy here, so for the illustrations, we're going to look at just one policy here. This guy, has a 10-year endowment policy, and he bought the policy. You can imagine, that this guy, bought the policy, 5 years ago. So it's already 5 years, since issue time. So this 10-year endowment, still has, 5 years, remaining, in the contract. Yeah. And in this table here, we put, the death benefit values, the cash values, and also the premium values, for each one of those 5 years, in the future. Uh, a client usually pays a level premiums, along, the contract time. So we're assuming here, that the premium rate or premium payment, per year, is 100 rupiah, say. You can use different units, of course. $100 or maybe 100 million rupiah per year. The five cash values, in the next 5-year period, are given, in that cash value column, 500 units at the end of this next 1-year period, 625, at the end of 2 years, from now, 750 at the end of 3 years from now, and eventually, 1,000 units, at the end of 5 years from now. How about the debt benefit values? For each one of the 5 years, we have 1,000 units, debt benefits. So if death occurs, in each one of these 5 years, anytime, 1,000 units, will be paid, to the beneficiary. For surrendering or lapse, cash values, will be given, to the policyholder. Yeah. And the policyholder will need to pay 100 units in each one of these next 5 years, in the future. So that's description, of the policy owned by the policyholder. And imagine we want to identify, the reserve value, the liability value, we want to put, in the balance sheet, for this policy, right? So let's move to the next slide. What kind of mortality and lapse rates, do we have here, for this policyholder? In this example, we assume that the mortality rates and lapse rates, for each one of those 5 years to the future are given, in this table. QX, is for the mortality rates, lapse rate, is for the lapse rate. And as you know, all these rates, are basically conditional local rates. Okay, so what is that 0.065? That's the probability of death occurring, in the next 1-year period, conditional on that the policy holder, is still alive at this time. Okay, and what's that 0.070, the QX, for year 2? That's the probability, again, it's conditional local probability. It's the probability that the insured, will be dead, in the second year, sometime in the second year, provided that he survives or she survives the first year. So he or she, will be alive, still, until the end of this next 1-year period. Then the probability that this insured, is going to be dead, in the following 1-year period, is 0.07. Yeah. So all these mortality rates, are local conditional probabilities, conditional on surviving until the beginning, of that period, of that 1-year period, we're considering. The same is true, with the lapse rate. So 0.1, for each one of these years, it means probability it's going to lapse, this 1 year, next 1-year period, is 10%, is 0.1. How about the probability of lapsing, in the second year? So sometime, between 1 year and 2 years from now, it's going to be again 10%. It's going to be 0.1. Conditional on what? The policy survives, the first year period. Yeah. So all these rates, are local probabilities. Yeah. Conditional probabilities. And that's usually the way they express, the rate in the industry, So all are expressed, in terms of local conditional probabilities. So that's the assumption, on lapse and mortality. How about the interest rate? Well, let's assume, that interest rate, is a stochastic process, a simple stochastic process, with finite dimension. The first possible outcome of the process, is that the interest rate, is going to be 7%, uniformly, in the next 5-year period. And it's assumed here, that the probability is 30%, it's going to be that way. Uh, the second possible outcome here, assume, is that each one of the interest rate, in the next 5-year period, is going to be 10%, uniformly. And the probability is 40%. And the less possible outcome is that it's going to be 13% uniformly in the next 5-year period with probability 0.3. So it's a very simple, stochastic process. Again, this is simplistic, of course, but the goal here, is to try to express, all these things, stochastically. So we can feel, the randomness, involved, in the process here. Next slide, please. Expenses, yeah, we have to have some assumption, on the expenses, the company will experience, on this one policy we're considering. So we're assuming here, that the expense, in each one of the 5 years, is going to be 5 unit, so 5 per annum with probability 50%. Or 10 units per annum with probability 50%. So it's like 5, 5, 5, 5, 5, as the first possible outcome with probability 0.5. And the second possible outcome is 10, 10, 10, 10, 10 for the next 5-year period with probability 0.5. Again, this is a very simple, stochastic process. Yeah. So we have 3 different sample spaces, we're dealing with here. Yeah. The first one, is we can go back again, to the previous slide, Yeah. One more. Yeah, that's the first, like the first sample space, we're dealing with, in the next 5-year period. What can occur, in the policy, is either death or lapse or surviving, until the end or maturity. Yeah. That's the first sample space, we're dealing with, in this policy. And then the second sample space, is let's go to the next slide. Is the interest rate, stochastic process. Yeah. So the interest rate, can be either 7% uniformly in the next 5-year period, per year, 10% or 13%. That's the second sample space, we're dealing with here. And then the third one is the expense, stochastic process. Let's get to the next slide again. Yeah. So let's move on, we're going to summarize, the sample spaces again. Move to the next slide. Yeah, this is the basically summary, of the first sample space with the corresponding probabilities, of the possible outcomes. Yeah. So a sample space, consists of uh, outcomes of possible outcomes of death in the first year, or lapse in the first year, death in the second year, lapse the second year, death third year, lapse third year, death fourth year, lapse fourth year, death fifth year, and finally maturity. Yeah, lapse uh, in the last year period, means the policy is maturing. Uh, so, uh, oh, I'm sorry, lapse first, in the fifth year. It means the policyholder, wants to discontinue the policy, sometime before the end, of that fifth year. Yeah. So if it's not happening, then the policy is going to be maturing, at the end of the fifth year. So those are the sample space with the corresponding probabilities. Yeah. Uh, we have the death probabilities, the lapse probabilities, and for maturity, we're going to use, that survival probability until the end of the fifth year, which is 0.37 there. Yeah, so this is basically something like multinomial, yeah, random variable. So let's get to, to the next slide. Yeah, this is again, summary, of the sample space, the multinomial, sample space, with the probability distributions, death first year, death second year, blah blah blah, lapse, first year, lapse second year, etc., and maturing, at the end of year 5. And we have the probabilities, for each one, of those. Uh, how about the second, random variable or stochastic process? Well, we have it already previously. Let's get to the next slide. Still the same, as before, for the interest rate and expenses. Now, of course, we're gonna wanna we wanna combine, the three sample spaces here, because at the end of the day, we want to look at the present value, right? So we have the multinomial random variable, we have the interest rate stochastic process, and we have the expense stochastic process. With all these three things, we're going to be able, to identify eventually, the present value random variable, in terms of sample space and density function. Yeah. So let's get to the next slide. This is basically the joint sample space, yeah, of the multinomial random variable and the two stochastic process. Yeah. And of course, we're having, this very much simplistic, assumption here, of independence. We assume, that among, the two stochastic processes, and the random variable, the multinomial random variable, among the three of them, there is independence. Yeah. So they're not affecting, each other, basically, that's the assumption here. I know this is very much, simplistic. Uh, there is a theory, of course, that interest rate, has a little bit of correlation, with lapse. Yeah. But we're not assuming, that one, here, for the sake, of simplicity. So with this independence, we can identify, the joint probability distribution, basically, and the probability, of each one of the possible outcomes, is going to be simply, the product, of the three probabilities, So we have the interest rate column, on the left, and then annual expense in the second column, and death or lapse, in the third column, and we have the probabilities, in the last column, on the right. So you can see, we're basically combining, the three. In this slide, we have basically combination of having 7% interest rate, 5 rupiah or 5 unit expense per year, and those death and lapse and maturing, uh, possible outcomes. Yeah. Next slide, please. In this slide, we change the expense, to 10 unit per annum. The other ones, being the same. And next slide. We have the interest rate, at 10%, expense, back to 5 per annum. Death and lapse, the same, and maturing. Yeah. Next slide. We have the combination, of interest rate of 10% per year and an expense of 10 units per annum, and death, lapse, and maturing, the same as before. And next. Yeah, here we have the 13% interest rate, combinations. Yeah, we can continue to the next slides. Yeah, continue. Yeah, so now with the three things, stochastic process of interest rate, stochastic process of expense, and multinomial random variable, with those three, we can derive, basically the sample space and the probability distribution function, of the present value function. The present value basically is a function of those three, right? So present value of the future net outflows is basically function of the multinomial random variable and the two stochastic processes. Now I have those words, C computation sheets, I don't have it here, I did it, in an Excel, but I didn't bring the Excel, with me, but you can trust me. For each one of those possible outcomes, previously, you can basically calculate the present value. Why? Because uh, you have the interest rate, yeah, for each one of those cells. You have also the expense per year, and you also have, the lapse benefits or the death benefits or the maturity benefits, depending on which cell, you're dealing with. If it's lapse, in the third year, then you use the cash value, of the third year, and then you present value that thing using 7% or 13% or 10%, and applying also, the annual expense rate. Yeah. So the outflows, will be either, the death benefits or the lapse benefits or maturity benefits and expense. And inflow, how about inflow? The inflow is going to be the premium payment. Yeah, we have the premium cash flow also, remember? And premium is assumed, to be paid, at the beginning of the year. Expense also assumed, to be paid, at the beginning of the year. But death benefits or lapse benefits or maturity benefit, is assumed, to be paid, at the end of the year. So with all those information available, you can calculate the present value. So here we have the sample space present value of future net outflows, the second column, from the right, with the corresponding probabilities. Yeah. Okay, let's get to the next slide. Yeah, basically, we're including, all possible outcomes here. Yeah, move forward. Next, yeah. Yeah, continue. Yeah. Yeah, there are so many combinations, so that's why, we have several slides, for this. Continue. Yeah. This is the rearranged, version, of that sample space of present value of future net outflows. So if we rearrange, those possible outcomes, from small, so we put those possible outcomes, in order now, from small, to high. So we rearrange, the sample space. We have this table here, the probability on the right side and the value, of the present value random variable. Yeah. So let's continue, get to the next slide. We're including also the median and the 75th percentile, I guess. Yeah, continue. Yeah. So the median, is that 409, 0.31, type, in both, and the 75th percentile, I guess, is that 414, 0.80. Yeah. Continue. Let's move to the next slide. Oh, I'm sorry. That's the median only. Yeah. So basically, the median, is basically calculated, as the average, of those two previous numbers. And now we have the 75th percentile, being the average, of the 461.48 and 463.64. Yeah. So let's continue. Yeah. Get to the summary part. Yeah, that's the one. So if you construct, the probability density function, of that present value random variable, it looks like this. Yeah. So it's not nice, like normal distribution, it's looking, like this, and the mean is equal to 446.85. The median is 411, 0.27, and 75th percentile 463.1. Okay. So how much money, does the company, have to allocate, for this policy? How much asset does the company need to keep, in the balance sheet, to be able to deal, in the future, with this policy? Well, the question is, what kind of probability of coverage, do we want to have? If we want to be able, to deal, with this policy, we want to make sure that the money, is going to be enough, with probability 75%, then we have to prepare, we have to allocate, 463.1 units, in the company, for this policy alone. Okay. Let's get to the next slide. So asset value, the company needs to have to be able to fulfill its obligation of paying future monthly net outflows related, to the above policy, with probability 75% is 463.1. If you want smaller probability, 411.27, is going to be enough, yeah, theoretically speaking. And in the industry, the difference between 75th percentile and 50th percentile is usually called risk margin. Yeah. Uh, how much money does the company have to put, in the balance sheet? The regulation in Indonesia requires company, to put reserve, equal to 75th percentile. Okay. But additional to that reserve, there is an additional, what they call capital requirement. If you look at balance sheet, in the balance sheet, you have the asset of the company, you have also the liability, the reserve, basically, of the company, the aggregate reserve. Uh, and aggregate reserve, can be associated, to the 75th percentile, of the reserve. Random variable, basically, present value of future net outflow random variable. The difference between total asset and total liability is what they call the equity, equitas, in Bahasa Indonesia. Yeah. There is this extra capital requirement, required, by the regulator, that the company have to have the equity, to be thick enough to cover, what they call the RBC. What is RBC? RBC is the short, for risk-based capital. Yeah. So equity is what they call the book capital, but there is another capital concept, called risk-based capital, which is a capital derived, following risk theory. Uh, the regulator basically requires company, to have the equity to be greater, than the RBC, the risk-based capital. And what is this actually, risk-based capital? Risk-based capital, is actually theoretically supposed, to be like the difference, between this 75th percentile and the 99.95th percentile. Okay. So if the equity of the company is greater, than this RBC, it means what? It means the company has assets greater than a level which has probability high enough, close to 100% of being able, to fulfill, future obligations. Yeah. So requiring company to have reserve equal to the 75th percentile, is not enough. The regulator requires company, to have extra capital, yeah, extra assets. And they want, the additional assets, to be greater, than that difference, basically, theoretically, between the 75th percentile and the 99.95th percentile. So basically what the regulator requires, is like almost 100% probability that the company will be able, to fulfill, its obligation in the future. So there is reserving regulation for companies. There's also this capital requirement, regulation requiring company, to have extra capital, extra assets, above the reserve, which is aiming, to put, the company in the position, of being able, to pay the obligations, in the future with probability close to 100%, basically. Yeah. So uh, that's the end of the presentation. If there's any question or anything, I'll be happy, to answer.